In this video, we're going to talk about Lucid Motors, trading under the ticker symbol LCID. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. So most of my videos are recorded and scheduled the day before and uploaded for the next day. For 5 days out of 7, it's a trading day, so of course by the time the video goes live on my channel, the price would have already evolved from there. If there are significant and very volatile movements during the trading day, obviously they will not appear in the video on that day. But usually, to the extent possible, my analysis will be based on the medium term and not really focused on the intraday movements. The reason why it shouldn't matter that much either way is because most people investing in stocks invest for some kind of reason that takes time to get developed, and that their positions are usually kept for at least a few weeks. With that being said, if there are significant stock price movements that happen afterwards, either they will not affect the overall picture, or if they're significant enough, they will be mentioned in the next video about the stock with reevaluations of the circumstances as needed. Lucid Motors is an EV manufacturer based in Newark, California, and was founded back in 2007. It went public in 2020 in the height of the EV craze, and I want to say the stock craze as well, and has been considered to be one of the most serious and true Tesla competitors in the sector. Another advantage that it can have, and I do personally believe in this argument, is that it's based in the US, so any sort of delisting risk doesn't really affect Lucid. It manufactures, designs, and develops vehicles that target high-end market because that's where most of the profit is. It has a great run back in 2020 and in early 2021, but then the bubble kind of busted and then resulted in a massive sell-off that lasted for months. The reason back then why shareholders are very interested in Lucid was initially because the rumors about a reverse merger with CCIV, which then fed into the speculation. But nowadays, I think that the main selling point is their car called Lucid Air and the outlooks and the reviews, because analysts and experts were very positive about it, which is expected to bring in a large amount of operating income and cash flows so that Lucid can keep developing new models and less reliant on raising capital by diluting shareholders. Lucid currently has 1.6 billion outstanding shares and quite a few prominent institutional shareholders like Citadel, Morgan Stanley, and Goldman Sachs. Actually, it is one of the companies where there's a very large institutional presence, which is something that is always very encouraging to see. Because despite the sell-offs that we have seen throughout 2021, the institutional ownership confirms that the stock always had the backing of those who are willing to invest in the long term. Lucid has decent quick and current ratios, which is a good sign, because that means that the company is remaining fairly liquid so that it can fulfill to its short-term obligations and will have no solvency issues, and will not be forced to dilute shareholders to raise capital. I mean, nothing says that it won't, but it won't be doing for that. Lucid had an amazing premium in the market, because its market cap is around $60 billion, even though its enterprise value is just $7.5 billion. This means that the market believes that it'll grow significantly from where it is now, and that it'll be able to become a significant player in the sector. Something very important to notice is its trading volume at the moment. Over the past 10 days, the average trading volume has been around 105 million shares a day, which is very significant compared to the average volume it had so far this year. Its beta is 1.35, which means that it is more volatile than the rest of the market, but not by that much. This is probably going to change going forward because the stock is currently going through a lot of upward momentum, which may keep going up or continue after some pullbacks. Its 52-week high was $65 and its 52-week low was $9.66. In terms of its options contracts, let's just say that it is favoring the calls options, but there is a lot of risk hedging going on as well. The key strike prices range between $35 and $40, and a rough estimate of the ratio between the calls and the put is approximately like 1-for-3 favoring the calls. This means that the market is quite bullish about Lucid Motors, which is a welcoming change after so many months of sell-offs and stagnation. I think that over the next couple of days, the stock will likely pull back a little bit just because it rose so much so quickly, and because the volume over the past 24 hours has been relatively lower. This means that there is an opportunity to benefit from the pullbacks and to increase the exposure in Lucid as long as the position is structured according to the risk profile of your portfolio. And overall, Lucid is a good stock to own, but the question is whether you're owning it at a reasonable price. I believe that the current price can be a reasonable entry point if you're in for the long term. But for medium term and like short term swing trades, there's a high probability that Lucid is going near its limit as far as the stock can go. So my recommendation is to buy around 5% of your portfolio in Lucid, and 50% of this allocation should be gradually added over the next few months in order to average down. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything, other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value, The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks, things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.